stick. Well, let's invite our market master for the morning. Tirthankar Patnaik, the India strategist at Mizuho Bank, is joining us as our market master. Morning, Tirthankar. Thank you very much for joining us this morning. Well, how have the Chinese devaluation turned things around? It looks like life is a lot more uncomfortable for commodity guys.
Well, definitely. It's suggesting that growth in China is probably weaker than expected. The response of the PBOC to probably market reaction in letting the yuan devalue a little bit, 1.9% to start with, is showing that the pressure on commodities is likely to remain. And we believe that this situation is unlikely to change anytime soon, really.
Okay, the situation is unlikely to change. Tirthankar, hi, good morning. Yesterday there was so much excitement and expectation of, a pre-policy rate cut from the RBI because of the way the inflation numbers have softened. Is that something that you're pricing in as well? And, how should the market approach this trigger?
Well, our sense was that prior to the events in China, prior to PBOC, devaluing the yuan, was that the RBI will take the first step only in the Jan to March quarter. While inflation trajectory has been on a downward glide path, while food inflation has been fairly comfortable, the sense was that RBI would wait for this uncertainty on monsoon to come off, the Fed rate hike uncertainty to come off before taking further decisions. What has changed is crude has been going down continually, and this event on the PBOC. My sense is that the RBI would probably accelerate the cutting in rates. We'll probably see a rate cut before the year is out, but we would rule out inter-policy meets. They are largely event-driven, and if the RBI had reacted, they would have reacted by now. Our sense is that they would not. Our sense is that the devaluation in China, if this episode does not continue for long, then the central bank would stick to policy meets for doing any kind of rate movements, and we maintain that another 25 basis points in this fiscal is something that we would look for.
Okay. Tirthankar, we did see a lot of sell-off of foreign investors up until end May, early June as well. But thereafter, we continue to see a goodish bit of inflows. India actually was the outperforming market if you look at it from, May, June, July, and the time when you started to see the Chinese markets shed a lot of weight and all that volatility in those markets. How do FIIs react now? We did see 2 days of selling. Should we take that as the trend going forward? Is India not the favored market it was in June and July?
See, the sense is India has been, we see that India has been a very strong outperformer across the entire emerging market space. While China was an outlier in terms of negative performance, other emerging market peers have not really lagged much, far behind. India, with its very strong macro in terms of, very low current account deficit, a very, well in control fiscal deficit, a good government, despite what's happening in the monsoon session, has been a standout performer, and the stability on the currency has really, been a one place where foreign investors have banked on. And from that perspective, some amount of realignment on the currency was expected, and which is why, if you notice, since the devaluation was announced, rupee has been one of the bad performers. Rupee had been an outperformer majorly, even more so than emerging market equities, and the Nifty, and the rupee has taken it a little bit hard. And from that perspective, we believe that some amount of realignment, FII is trying to book profits where they see emerging market risk overall increasing, and not bothering to really check between countries in terms of reallocation, getting capital out of the emerging market space. So from this context, in the short term, one would expect the Indian markets to remain under pressure. One would expect the INR to remain under pressure. One would expect FIIs on the debt and equity channels to be both circumspect about putting more money into India.
Okay, let's talk about individual sectors now. You've been bullish on the IT sector for a while, and this time around has been very interesting because the dynamics of the top tier companies has changed, with emphasis now back at the top rung of the ladder. What is your own pecking order? What are the what are the 1, 2, 3 stocks that you would recommend in the IT space?
See, we continue to remain positive on the IT space. I would not like to take individual names at the moment, But the sense we are getting is that dollar growth performance by the IT sector in the first quarter was one strong move for the sector, and which basically supports our thesis that the IT space is likely to perform going forward, and the tailwinds that we are getting from a weak currency are likely to help even the mid-tier IT companies. So we will maintain our overweight on the IT space, and though I'd not like to take any specific names here.
Okay. What are your domestic plays? I see you're positive on IT, pharma and auto ancillaries, largely export-driven companies which will also benefit from the rupee. But before I come to those, are there any domestic plays that you like? People are celebrating the urban consumption story a bit.
Well, what we would like to say is that the way the Indian macro is performing, the way the Indian economy is growing up, we would see some amount of fillip on consumption.
Okay.
Lower cost of funds over the next 2-3 quarters are likely to boost consumption as well, especially in the durable space. And we've seen that happening over the last 2 to 3 months. So maintain our positive stance on the durable space in consumption. But in India, we would be cautious on certain sectors. We would be cautious. We remain cautious on public sector banks. We remain positive on private sector banks. That valuation differential has really expanded, but we would maintain. So we don't see it as a time where one would want to enter public sector banks as a contra bet. We would maintain our caution on the telecom space about what's happening on. We believe that voice revenues would continue to get cannibalized going forward by data, especially after one player has announced 4G right now, and we are likely to see another 4G major announcement before the year is out. So telecom is one space we would remain cautious about, and where we would again see a little bit of caution is cement, infra. These are spaces where growth is likely to remain tail-ended, and what we will be pushing in India is consumption. What we will be pushing in India is global plays like IT and pharma, and of course auto ancillaries. CVs in the auto space have also done well. We've seen, of course, 2015 was a year of a very low base rate, but we see movement happening there as well. So auto in general, auto ancillaries in particular will be sectors that we will be positive in India over the next 2 to 3 quarters.
Okay, well, you were talking about pharma names. I just want to pull up the stock of Glenmark Pharma. That one is now up almost 8%, in fact, little over 7%, and it's hit a fresh 52-week high after news that it will be added into the MSCI index. Tirthankar, do you see better returns outside the heavyweight pharma stocks, or do you think that you should still stick with the top-tier names?
No, our sense is that performance in the pharma space would branch out to beyond the top tier names. We should be positive across the mid cap pharma space as well, where there is added benefit of index inclusion naturally, which will invite asset allocation by both passive and as well as active investors. So I would be broadly positive on the pharma space really.
Okay. Well, Tirthankar, thank you very much for joining us with your thoughts on a bunch of macros and micros.